smart. I think what would be smart would be to do them and to sell them to some of the greedy investors on Wall Street and let them collect them. Interestingly enough, about 120% loan to values loans, actually the people that get them are more credit worthy, have better credit ratings than people that get more conventional loans. They're usually people that are doing it for, a lot of times for the tax advantage. So it's actually pretty decent credit quality. What nobody knows is even good people with good credit, when a recession comes and you're without a job and you're looking at no equity, in fact negative equity in your home, how would you perform? And we know from the last recession, homeowners performed poorly. You know, when you don't have a job and there's no equity in your home, you tend to leave the keys at the bank door. Understandable. So I'm not sure that how this is going to play out from a credit standpoint. I actually worry about it more from a social standpoint than I do from a credit standpoint. I think we're really changing the whole sort of social covenant in America without perhaps thinking through to what the inevitable consequences are. Something that scares me a lot about consumer credit, and I, by the way, think consumer credit's totally in the crapper and no real growth business for the financial services industry. The one sector that's an exception to that is home financing, and I'm including in that home equity financing. If you think about the growth in consumer credit, and you all know that consumer debt is, as a proportion of household income, is not at its historic highs. It's actually come down since the last recession, but it is very high, and the only time that it has been higher was in the last recession. So it's higher than prior to the recession. It's only come down a little since the recession ended. If you look at the amount of consumer credit on the one hand, and you look at the amount of money we have invested in the stock market, and I knew we'd gone over when my own sister, the school teacher, was not investing in mutual funds, but she now buys individual equities. So think about how much money, I talked about how much money flowed into the market since 1974. What keeps going through my mind is, basically, we have financed speculative investment in the market. Now, I'm not here to tell you people actually came to the bank and got a loan to go invest. I mean, that's not what they do. But how many of us can remember from the 1970s when people would be sitting with a $2,000 balance on their credit card paying 19% interest and have $2,000 in a savings account earning 4%? The same thing has happened today, except the $2,000 is now $20,000, and it isn't in the FDIC insured savings account. It's over here in the stock market, where people think it's normal to get 20% returns. So the thing that scares me about consumer credit is that a lot of people owe a lot of money, and I think a lot of that money went over into the stock market. And when that goes down, it's not like your home. You know, when there's no equity in your home, if you still have a job and you can make the payments, you make the payments. It's where you live. When all of us feel the pain and the poverty, the psychological poverty of seeing our net worths decline because the market inevitably will decline, how are people going to feel about repaying consumer credit? I don't have the answer to that, but that is kind of like whirls around in my mind, and why I chose not to be an aggressive consumer credit lender the last couple of years when I've had responsibility for that business. I just don't think the long-term fundamentals bode well. Yes?
Could you talk about the trade bank? We don't hear much about the joint venture and how that's doing it. If the earnings go up to our earnings, because we haven't included that.
Ian's asking about the trade bank, which is our joint venture with Hong Kong Shanghai Bank, where we share ownership in a bank that is engaged purely in trade finance activities, primarily with California, I shouldn't say California, although it is disproportionately in California, but West Coast companies that engage primarily in Asian trade. And the trade bank, in some respects, has exceeded expectations in terms of customers and volumes. In others, it's been a little disappointing. I think to be probably more honest than the trade bank wants me to be, I don't think they've yet mastered the credit model for it. So they do very well with the customers that we know. For example, commercial banking's customers primarily. And they've done very well at penetrating that market and increasing their cross-sell, and they're very profitable on that business. When they step outside of that, they've been hammered with just too many credit losses for the size of that portfolio. And again, it's primarily from stepping outside of the narrowness of the customers we know. So they clearly don't have that credit model nailed at this point. They're in an early stage, and so a credit loss to them is relatively small, even by our standards, let alone the new Wells Fargo standards. So in some respects, it kind of reminds me of us in 1990, 91, when we were learning, painfully sometimes. Yes?
Terry, what changes will our group see as a result of the merger with, or the combining of Norwest?
Merger is the technical term. Well, it's amazing. Think about it. November 2nd, we're a whole new company. The name's the same, but we're really a new company. I think several things will change. Over the summer, when we were doing the best practice review and the business assessment, what we attempted to do was to really understand not only, it started out narrowly as sort of a best practices review, stacking one thing up against another, systems versus systems, products versus products, business practices, etc. But it also couldn't go much further without sort of stepping up a level and saying, we've got two fundamentally different business models here, and we need to assess that, not just the practices below the business model. If you think about the business model that Norwest has, the best way to characterize it, and in fact the way they would characterize it, is it's a community banking business model. And the business model that Wells follows, we characterize as a line of business model. So we're organized around lines of business. They can be lines of business around products or around customer segments or around a channel. You are really largely around, I know you're changing and have been evolving, but you've historically been around a product, small business loans. So it's a product within a subset of a customer segment, small business. In Norwest, they're organized around a community banking model, which is therefore very geographic in nature. If you go into a region, go to St. Cloud, Minnesota, which is quite a small town, by the way, although I understand pretty big by Minnesota standards. It's kind of like a zip code of L.A. No, it's not a zip code of L.A. It's kind of like a zip code of Fresno, actually. I tell you, I had a tough time in the Midwest. I kept thinking they left zeros off of the numbers, I'd never been to places where they had 20,000 people. And then it'd be literally 20,000 people would be 100 miles before you got to the next town. It's, I'm just, I'm an East Coast, West Coast girl. I didn't get it. You really kind of have to go there to understand the whole community banking thing, because it's built upon the concept understand their model, which is very regional in structure, and ours, which is organized in this line of business, came out of two entirely different business contexts. So did any of you ever live in a unit banking state, grow up like in the South or the Midwest? See, if you're from California, you don't get this, because California never had anything but branch banking. And most of the rest of the United States, branch banking is a very recent phenomena. I grew up in Florida, which was a unit banking state, which meant that a bank could be a unit, but a branch was a bank, and that was it. And if you wanted to have more than one branch, you had to have multiple banks. And you could own multiple banks within a holding company, but every bank had its own board of directors and its own officers, and it had its own SEC and OCC and Federal Reserve reporting requirements. It was a bank. Now, in some marketplaces, like particularly in the Midwest, it wasn't unit banking, it was county banking. So you could have as many bloody branches as you wanted, but don't cross those county lines. So Norwest came from a context of unit banking, also a physical context. Think about the geography of the plain states in the Midwest. Small town, land, small town, land, small town, land. So the unit bank concept, that's why it grew up, was because of that geography. Who cared about the branch in the next town? The next town was 80 miles away. We're used to branch banking. We're used to a very dense marketplace. California is one of the most urbanized markets in the world. 93% of the people that live in California live in a city. In most of the Plain states, that's somewhere between 50 and 60%. In fact, they are the least urbanized geographies in the United States. So our business